I think as an investment manager, it is the nature of the game to have concerns. It is the biggest risk we have as investors is to be complacent about the year ahead or any period that we are facing. So of course I have some concerns. We remain in an environment which is extremely uncertain on many aspects. The recent elections in the US also raise a number of questions in terms of what President Trump will do in his second mandate. So that raises concerns in terms of tariffs, potential trade wars, not only between the US and China, which is the main target of Trump, at least in the early stages, but also with Europe and with the rest of emerging markets. If we see trade wars, this is likely to be inflationary. So while we are now at a stage where it looks like interest rates have peaked in this investment cycle, we cannot rule out a return of inflation which would lead to a pause in the interest rate cuts that we have started to see across the world.
Going into 2025, we still have a war ongoing on the European continent. The concern is that continues to rage as we go through the course of the year. Of course, the other concern would be that it ends fairly abruptly and markets react in quite a significant way. There is a big discount between the European market today and the US equity market. That could close very quickly, for example, if that conflict was resolved abruptly. We also have relatively low consumer confidence. That's partially sparked by the geopolitical backdrop and by the backdrop as regards interest rates and inflation. So any material changes in those factors could, of course, have a significant impact on overall demand levels for our companies.
Investors are still worrying about the lagged impact of those interest rate increases and whether the recent change in monetary policy is too late. We are seeing weakness in many economic indicators, and corporate earnings growth outside of the Mag 7 and a small number of outliers is sluggish. Corporate revenue growth in the United States, if you exclude Apple, Microsoft, Amazon, Nvidia, Meta, and Google, was just 2.9% in the most recent quarter. It seems clear that a two-speed economy is here. Perhaps another explanation for the concentration of returns in a market where growth is hard to find.
In terms of the fixed income markets, we've had a very strong rally in spreads over the last number of years, which isn't a surprise. I think global economies are in very good shape, and central banks are now in a position to help by cutting rates. So it's not a surprise to see spreads being quite tight. But of course, when you have a period like that, again, you do need to be a little bit more cautious. I think one of the bigger risks at the moment is probably equity markets. You know, the dynamic bond fund is not exposed to equity markets, but all markets are correlated. And I think when you see valuations in equities being as high as they are, there is always the chance that you will get some profit taking at some stage and maybe a correction in equity markets, which could, of course, spill into credit markets. However, I think there is a lot of cash on the sidelines. The technical drivers for fixed income markets are very strong at the moment, so we wouldn't expect a lot of spread widening. Nevertheless, I think it will be another volatile year for various parts of fixed income and probably in particular government bonds.
The regulation of AI in particular is something which continues to be a feature of the artificially intelligent world that we think will persist for as long as AI remains a separate endeavor. So it's not so much a risk as a feature of the artificially intelligent world, and one that we have to try to understand as best we can. I think the last thing which we're keeping a close eye on is NVIDIA. You know, quite how big is NVIDIA's addressable market over time, and how successful can that company be in reinventing itself, not merely as a provider of high-end parallelized silicon upon which the artificial intelligence world is built, but beyond that, into an ecosystem provider, providing the software framework and related services around the whole of the artificially intelligent stack, upon which then services and products will be delivered.
My primary concern really, though, remains the negativity towards the UK, and we've seen relentless outflows from UK-focused equity funds over the last few years, and I need and want and desperately hope to see that negativity and that sentiment improve as we move through 2025. That would be my primary concern, is that we don't see that improvement. I'm optimistic that we will, but only time will tell.
The consensus strategy is to be cautious, and volatile markets are reinforcing this. Cash and money market funds just hit a record of $6.3 trillion, bearing this out. It's right to be balanced and have a portfolio that thrives in a variety of economic outcomes. But burying your head in the sand is probably wrong, as the best returns come when you least expect them.